American spirits exports to Canada collapsed by 85% in a single quarter. Foreign holdings of US Treasuries dropped by $138.4 billion in 1 month. And a consumer boycott that began in Canada has crossed the Atlantic into Europe. On the surface, these look like 3 unrelated events. They are not. Together, they form the early warning signs of a much larger shift, one reshaping trade, manufacturing, investment, and the future of North America's entire industrial base. For decades, businesses built their operations around 3 assumptions: stable supply chains, predictable trade relationships, and steady investment flows. All 3 are now being challenged from multiple directions at once. What started as a disagreement over tariffs has become something far larger, a test of economic trust, consumer influence, and where global capital chooses to go. And the data suggests the pressure is not falling where Washington expected it to fall. The most surprising development is how ordinary consumers turned a boycott into an economic weapon. This was not a government policy. It was millions of individual purchasing decisions. The clearest example came from Canada, where US spirits exports plunged 85% during the second quarter of 2025, falling below $10 million. Wine, beer, and liquor exports all suffered as provinces pulled American products from store shelves, and consumers actively chose domestic alternatives. American wineries and bourbon producers felt the impact immediately. Beam Suntory's production pause in Kentucky showed the consequences directly. And here is the part that should worry American brands most. Much like automotive buyers who switch to a different brand, consumers who embrace alternatives often prove very difficult to win back. The damage did not stay inside Canada. What began as a local boycott started crossing oceans. Anti-American consumer sentiment gradually spread into parts of Europe. Surveys in Germany showed some consumers deliberately avoiding American products. Polling in France revealed support for boycotts targeting brands such as Tesla, Coca-Cola, and McDonald's. In Denmark, the political controversy surrounding Greenland fed into a backlash against certain American goods. Most Europeans continue buying American products, but the trend points to a growing reputation problem that did not exist before. Modern boycotts spread rapidly through social media, shopping apps, and retailer promotions. And Goldman Sachs estimated that widespread foreign boycotts could reduce US GDP by between $28 billion and $83 billion. And if you want the real story behind how Canada is still holding its ground through tariffs, wars, and hard times, hit join below to join the membership for exclusive documentaries you won't see anywhere else about Canada's progress and rise through uncertainty. For automakers, this shift changes the equation entirely. Brand trust now matters almost as much as engineering performance, battery range, and pricing. A vehicle can be technically excellent and still lose sales if consumers associate the brand with a country they feel is treating their own nation unfairly. But consumer backlash is usually a symptom rather than the root cause. To understand why these movements gain traction, the political tensions that strained one of North America's most important economic partnerships have to be examined directly. For decades, the United States and Canada operated one of the most integrated economic partnerships in the world. Vehicles, energy products, agricultural goods, steel, aluminum, and countless components crossed the border every single day. That relationship became strained as tariffs expanded and political rhetoric intensified. Many Canadians came to view the tariffs on autos, steel, and aluminum as economic pressure aimed directly at a close ally. The automotive sector illustrates the risk most clearly. Modern vehicles depend on cross-border supply chains, with parts often moving between the United States, Canada, and Mexico multiple times before final assembly. Uncertainty raises costs and complicates long-term planning for battery plants, engine programs, suppliers, and assembly facilities. And once trust is lost, it is difficult to rebuild. There is another dispute that sounds small on the surface, but could carry consequences far beyond the product itself. While tariffs on autos and metals grabbed the headlines, a quieter battle emerged that could set a surprising new precedent for global trade. In May 2026, the US Commerce Department announced preliminary countervailing duties on fresh Canadian mushrooms, with rates ranging from 1.62% to 4.97%. American officials argued that certain Canadian producers benefited from government support considered unfair under trade rules. Canadian producers responded that similar agricultural tax policies exist in the United States. That response is where the dispute becomes significant. If agricultural tax treatment is increasingly viewed as a subsidy, other countries could apply the exact same argument against American exports, creating broader risks for US agriculture than any single mushroom tariff ever could. But the biggest shift may be happening somewhere else entirely, in the global flow of capital. The most consequential development is not on farms or store shelves. It is in the capital markets. Canada has long been viewed as a stable, resource-rich economy that often receives less attention than larger investment destinations. That perception is changing. Foreign direct investment into Canada reached $96.8 billion in 2025, the highest level in 18 years. Investors are increasingly drawn to Canadian energy infrastructure, critical minerals, LNG projects, manufacturing, and defense industries. Meanwhile, foreign holdings of US Treasuries fell by $138.4 billion in March 2026. The broader story here is diversification rather than abandonment. Investors are not fleeing American assets wholesale. They continue allocating significant capital into other parts of the US economy. But the direction of the marginal dollar has shifted. When a country records its highest foreign direct investment in 18 years, at the same moment that US Treasury holdings dropped by $138 billion, in a single month, the pattern points to capital seeking new destinations. And for the automotive industry specifically, this matters enormously because where factories, battery plants, mineral projects, and supply chains get built depends heavily on where capital chooses to flow. That capital shift is the development with the longest lasting consequences. Consumer boycotts can reverse. Tariffs can be negotiated away. But once a battery plant is built in Ontario instead of Ohio, once a critical minerals processing facility is financed in Saskatchewan instead of a US state, that infrastructure stays where the capital placed it for decades. The $96.8 billion in foreign direct investment into Canada in 2025 is not a temporary reaction to political headlines. It is physical industrial capacity being located based on where investors judge the long-term environment to be most stable. What started as a disagreement over tariffs has evolved into a much larger conversation about consumer influence, economic trust, supply chain resilience, and global investment flows. The United States remains the world's largest economy and continues attracting substantial investment. But the warning signs are becoming harder to ignore. Canadian consumers have changed their purchasing habits in ways that have persisted for over a year. Boycott sentiment has appeared in parts of Europe. Trade disputes are expanding into new sectors like agriculture that could set precedents against American exporters. And Canada is positioning itself as an increasingly attractive destination for the long-term investment that determines where the next generation of factories gets built. The 85% export collapse, the $138 billion treasury drop, and the cross-ocean boycott are not three separate stories. They are three symptoms of the same underlying shift, a change in how consumers, investors, and trading partners respond when the economic relationships they once treated as permanent begin to feel uncertain. For an automotive industry built on stable supply chains, predictable trade, and steady capital, that shift is the development that could reshape where vehicles are manufactured across the entire continent for years to come.